Start with the ultimate signal of doom. The U.S. national debt is not slowing down. It is projected to shatter the $36 trillion barrier in 2025. That number is not a projection. It is a death warrant for the current financial structure. Every collapsing regime in history used this strategy. They printed money. They bought time. They killed their own currency. Think of the silver-rich Roman denarius. It was clipped down, debased until the metal vanished. The empire fell. This is the recurring mechanism of financial collapse. We are watching the precise moment where trust in paper money dissolves. The pattern is now at your doorstep. But the paper game has a massive flaw. WallStreetBets knows it. They are the new market mechanics. They spot the greatest, most concentrated short position in history. That weak point is silver. It is the cheapest, most neglected, most manipulated asset on the planet. The historical cycle is completing itself now. The setup for a catastrophic, violent short squeeze on silver is locked in. The final consequence is no longer political. It is purely mathematical. The suppression mechanism is deeply rooted in history. It didn't happen by accident. The pattern began in 1964. That year, the U.S. government made a decision. They removed silver from all circulating dimes and quarters. This was not about convenience. It was about simple economics. The silver content in those coins was worth more than the coin's face value. It was an inevitable calculation. The government faced a choice. They could maintain sound money, or they could debase the currency. They chose debasement. They decided the political promise was more important than the mathematical reality. That single action paved the way for the decades of inflation and debt we now face. It broke the link to physical discipline. For years, the price of silver was held down. It was anchored by law at around $1.29 per ounce. This was a fake price. It created an illusion of monetary stability. It was an engineered lie. Once the link was severed, the inflation accelerator was pushed to the floor. The world was now fully committed to the unbacked paper system. Then came the late 1970s. Inflation exploded. It was a direct, logical outcome of endless money printing. The Hunt brothers saw the systemic stress. They were not naive. They understood the historical pattern perfectly. They realized silver was massively undervalued. They knew scarcity was the ultimate power. The global paper promises were inflating out of control. The physical metal supply was not changing. It was finite. The Hunts began buying. They bought physical metal and futures contracts. This was not mere speculation. It was a trade on the inevitable collapse of the paper dollar. In January 1980, the result was clear. The price of silver skyrocketed to almost $50 per ounce. This spike was a raw signal of paper money failure. People were desperate for an escape route. Hard assets were their only defense. The pattern always holds true. The centralized power structure panicked. They could not allow the people to expose the weakness. They did not fix the currency. They did something much worse. They changed the rules. The COMEX exchange introduced a chilling piece of systemic defense. They called it Rule 7. It was infamously dubbed the Silver Rule. This rule immediately restricted new contract buying. It forced leveraged speculators to liquidate their positions. This was not a market correction. It was a cynical financial execution. It was designed specifically to save the massive short positions. These shorts were held by the large banks, the powerful insiders. This event is a foundational moment in the pattern. Proved the market is not a fair playing field. When their power is threatened, the rules are instantly suspended. The system is managed, not free. On Silver Thursday, March 27, 1980, the price collapsed violently. It fell from nearly $50 down below $11. This was a manufactured crash. It was a deliberate destruction of wealth for those betting on physical reality. The establishment sent a clear, brutal message. Do not challenge our price-setting mechanism. For the next 4 decades, the pattern of suppression became refined. It became structural. Large financial institutions found a perfect tool. They could suppress the price by selling paper contracts for silver they did not own. This is the paper game. They created an infinite supply of phantom metal through derivatives. This is the central logic of the modern pattern: infinite paper versus finite metal. This is the risk that has accumulated year after year. We must look at the paper-to-physical ratio. This single number is the smoking gun of the systemic manipulation. For every single ounce of real silver in the COMEX vaults, there are not 10 but hundreds, and at times even thousands, of paper claims against it. This structure is a mathematical impossibility. It relies on one crucial, fragile assumption. That assumption is that almost no one will ever actually demand delivery of the physical metal. That assumption is the entire system's vulnerability. Consider the actual annual mine production. The world mines only about 800 million to 1 billion ounces of silver per year. That is a fixed small supply. Yet, the paper trading volume on a single heavy day often exceeds that entire year's production. This is financial insanity. It is evidence of a wholly disconnected, synthetic market. The paper tail is now controlling the physical dog. It is not a market. It is a leveraged, high-stakes casino. The logic deepens because silver is not just a monetary relic. It is an industrial necessity. The demand for silver in new energy technology is relentless. Every modern solar panel, every cutting-edge electronic device, requires silver. Industrial demand is accelerating. But the paper market keeps the price artificially low. This suppression is a subsidy. It keeps a vital industrial metal cheap for powerful corporations. It is the systemic injustice we track. The systemic logic is absolute. A commodity with fixed supply and increasing, critical industrial demand cannot be held down forever. It is an unsustainable pressure cooker. The enormous short position created by years of paper selling is a financial time bomb. It is a concentrated risk held by a small group of highly leveraged banks. When the price finally breaks, these shorts will be forced to cover their positions. They will need physical silver. It does not exist in the necessary volume. This is the precise definition of a squeeze. The system is mathematically overextended on silver, and the calculation is nearly complete. We apply this cold historical logic to the present. The crowd at WallStreetBets are financial mechanics. They are not following hype. They are identifying a massive structural flaw. They understand the manipulation. They saw it in the GameStop squeeze of 2021. They recognize a concentrated, vulnerable short position that is ripe for destruction. This time, the target is not just a stock. It is a physical asset with global, indispensable use. The pattern of economic collapse is in its late stage. The debt is piling up faster than ever. The USM2 money supply surged by nearly 40% following the 2020 response. This flood of new currency is the guaranteed engine of deep, corrosive inflation. Money is being destroyed at an alarming speed. The historical reflex is simple. People flee paper. They demand safety in real assets. We are seeing critical physical signs. The silver inventory in the COMEX registered vaults is in freefall. It is dropping to dangerous multi-year lows. This is not inventory that is merely eligible for delivery. This is the silver actually available to meet contracts right now. This is a direct physical indicator of stress. The system is running out of physical metal. At the same time, gold has blasted through all-time price highs. Gold has done its job. But the gold/silver ratio is still massively distorted. The historical, disciplined ratio was close to 15-1. Today, it remains stubbornly above 80-1. This imbalance is the loudest market signal. Silver is the most mathematically undervalued hard asset available. The systemic logic demands a violent rebalancing of this ratio. It is the compression phase before the violent release. The WallStreetBets logic is sound. They see the fragility of the entire paper edifice. They are looking at the massive billions of ounces open interest in futures. They know these contracts are just promises. They understand that a small, sustained push for physical delivery or a major purchase campaign on physical-backed ETFs can expose the lie. The paper price must converge with the physical reality. That mechanism is called a squeeze. The completion of this pattern will not be an orderly correction. It will be brutal. It will be a catastrophic failure of the derivatives market. A short squeeze in a physical market is a guaranteed price explosion. The institutions on the short side, holding these leveraged positions, face total existential failure. They will be forced into a frantic, chaotic scramble for physical metal. They will pay any price. The systemic risk is enormous. The failure of large short holders in the silver market could trigger a cascade. Counterparty risks are complex and hidden. The distress will flow directly into the broader financial system. The price of silver will not simply rise. It will reprice permanently. It will reflect its true scarcity. It will reflect its critical role in the modern industrial structure. This is the system destroying a decades-long lie. This scenario is what should keep you awake at night. The financial elite proved in 1980 they will change the rules to survive. But the sheer scale of global debt and paper leverage is far greater today. They are losing control of the pattern. The historical rule is about to complete. The consequence is mathematically unavoidable. When the squeeze hits, it will be the final, undeniable proof. Our financial markets are totally divorced from physical reality. This is the final warning. This video explains historical and economic systems. It is informational, not financial advice or price forecasting. We have tracked the pattern across the centuries. Debt explodes. Money is debased. Physical assets are suppressed. The political promise always fails. Eventually, the mathematics takes over. The WallStreetBets movement is only the initial tremor of an inevitable structural collapse. Subscribe to this channel now. Keep tracking the completion of this pattern with us. Join the membership for our detailed analysis of systemic fragility. We follow the numbers that will destroy the illusion. The promise is political. The consequence is mathematical. No one escapes.